Hello and welcome to Portfolio Matters Week 73 Jubilee edition. But before we get into it, Richard will read the disclaimer.
Thank you, Keith. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we will be discussing securities that we own or have a financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. A full disclaimer can be found at the end. Keith, what do we have this week?
Well, very busy market again. So, news this week was that the EU agreed a partial ban on Russian oil exports, overcoming Hungarian resistance. So, they have agreed to block all imports by sea, but not by pipeline by the end of this year. And then separately, Germany and Poland have agreed to cease pipeline imports. The net effect of that is that will ban around 90% of Russian oil imports to the EU. So that will really tighten the market, you'd expect. Separately, OPEC has agreed to boost output by 650,000 barrels a day in July and August. Now, they were due to boost output by 400,000 barrels a day. But, so show you some charts later, they are failing to meet their current quotas. So increasing the quota may not have much of an effect. Shanghai has reopened, and we've got a section on the Chinese economy coming up. And it was a bad week in bond markets. So Joe Biden reiterated his commitment to Fed independence, and various Fed governors came out with quite punchy statements about future rate rises. That may be part of the reason behind the sell-off in the bond markets, expectations of more rapid rate rises. So moving on to this week's economic data. Now, we had new inflation numbers out in the EU, and they weren't good. So in April, EU CPI was 7.4%. The market was expecting it to increase slightly to 7.6%. Instead, it shot up to 8.1%, a big rise. So that's showing that inflationary pressures in the EU continue to rise strongly. Core CPI also rose above expectations. In Germany, inflation again beat expectations. Now, in the UK, we had the nationwide house price index. Actually, that's in the wrong place. That should be for April. And that showed continued strong house price growth, which is surprising because I was expecting it slow given the rate rises and the squeezing of incomes by food and energy prices. Now, we've got a section on China coming up. Essentially, the data portray a Chinese economy which is slowing, but the rate of decline is easing. So it seems to be strengthening from a low base. In the US, house prices continue to rise, beating expectations. And then we had ISM manufacturing surveys, and these were reassuring, but led to a sell-off in equity markets as the market expected the Fed would have to raise rates higher than previously to counteract a strong economy and strong inflationary pressures. So US manufacturing orders beat expectations and grew 2.2% month on month in April. Some charts, Richard.
Thank you, Keith. So EU economic sentiment is still above 100. It's not looking. It's hard to tell whether it's reached a sort of base or whether it's going to continue to drop. not looking desperately healthy. EU industrial sentiment not looking particularly healthy either, although well above zero. And the EU services sentiment is holding up much more strongly at sort of level it's been at since around about 2016, pre-COVID.
Yeah, surprising strength given all the headwinds the European economy is facing.
Yeah. And EU CPI, this looks like the PPI chart, only it's 1/4 of the height. And it's showing no inclination to stop rising meteorically. I suspect it's going to rise considerably further before it starts to level off or fall. And EU core CPI, which, given that PPI is 30-something%, this doesn't actually look like a realistic number to me, but the trajectory is very clear.
Yeah.
Germany CPI. The China manufacturing PMI, as Keith commented, the question is the Chinese economy beginning to revive? We'll talk more about that later. And likewise, China non-manufacturing PMI still below 50, but a big tick up from last time. And general PMI reflecting that. US job openings are still strong. And the quits rate seems to be leveling off a bit, which suggests the market jobs market may be maturing. ISM manufacturing new orders. It sort of looks unhealthy, but it's not really. It's well above 50 and it's just ticked up. So I think the jury is out there. And US ISM manufacturing prices paid has basically seems to have leveled off over the last few months. Manufacturing employment in the US is coming down. The house price index, we thought it was coming down a couple of months ago, and it has ticked back up. And US factory orders looking strong. The 30-year mortgage rate just declining slightly, although still at a very high level compared with where it was this time last year. Initial jobless claims appears to have reached its low point in April and now appears to be creating a little bit of an uptrend. And continuing jobless claims looks like it has plateaued at a pretty low level there. So our summary is Chinese economy remains weak. I would say we'll talk more about that. The European economy is remaining very resilient, but as we'll see in a bit, the inflationary pressures are still building. The US economy is not slowing down noticeably at the moment, and there's some volatility in the numbers, but we can't draw the conclusions it's yet slowing down. And UK, US housing markets are very strong.
Thank you, Richard. Okay, this week's one chart is sterling. So this is the chart of sterling over the last 50 years. And it's been a pretty, well, actually, it's not been a steady decline. It's been a very volatile decline. And Brexit, actually, when you look at it in the long term, Brexit does not appear to have had a huge effect. But this week, various analysts, but particularly Bank of America, warned about sterling. And they said that sterling risks becoming an emerging market currency. And they highlighted the following vulnerabilities. The UK runs a big structural current account deficit, and therefore it needs to continually attract investment, i.e. foreign capital, to balance the books. And we have a fraught relationship currently with our main trading partner 25 miles away across the English Channel. And if Boris Johnson were to go through with his threat to repeal the Northern Ireland Protocol and worsen our relationship with the EU, then the outlook for the UK economy could get materially worse. And we are going to do a special section on Brexit in a bit. But they also said that they're worried, Bank of America were worried about the politicization of the Bank of England, which is perceived as failing to meet its mandate. And I'm going to read this. Whilst not wishing to over-exaggerate sterling's predicament as some kind of end-of-day scenario, we are concerned that the increasing politicization of UK policy undermines sterling in ways that would appear emerging market-like. We sense something is changing in the UK, with the Bank of England increasingly hard to decipher and less transparent. A failure to discuss and acknowledge that Brexit has been a significant headwind to the supply side, and a sense that the Bank of England is losing control over its mandate. Now that's interesting. That's from Bank of America. If he's right, and international investors begin to lose confidence in sterling as an investment currency, then what are the implications? Well, the UK needs to constantly attract capital to balance its books. If that capital were to perceive sterling as no longer being a safe haven currency and to avoid the UK, essentially what it would mean would be that they would demand higher interest rates or higher rates of return to invest in the UK. So the Bank of England would be expected to have to raise rates because there'd be a sell-off in sterling, and that would be inflationary. And in order to defend the currency, the Bank of England would need to raise rates.
So I don't disagree with the Bank of America analysis. I think it is that the European system is analogous to us. They have many of the same problems, and it's this bind between supporting the currency and having to raise interest rates, and raising interest rates driving the economy into recession. And we are in a dangerous place, I think, and I think they're correct to point this out. And it obviously leads you on to saying, well, if they are correct, what are the investment implications for all of us? Where do we put our cash? Because we either have a plunging currency, which is very inflationary, or we have very high rates of interest, which is very poor for asset prices.
Yeah, we've previously done a special on why central banks are trapped, and this is exactly the dilemma. They try and raise interest rates, they risk pushing the economy into recession. If they don't, then international investors and the bond markets lose confidence in British assets and rates sell off anyway, and sterling falls. Yeah. And it may well be that we've reached that point. Now, as Richard just said, what are the investment implications? Well, if you are a British citizen and you have most of your assets in sterling, then you need to consider holding overseas assets or gold to protect yourself against a big fall in sterling. Now, the great news is the gold market is amazingly liquid, and you can buy the ETF in very large size with no impact, as far as my experience has been. And I would caveat the Bank of America warning with the fact that, we've had loads of sterling crises over the years. The 1992, the sterling crisis of 67, etc., and general decline as we have higher inflation than other countries. And there's no evidence that I can see in the chart of sterling that we are losing the confidence of international investors. And also, I would say that, in an ugly contest, I don't think we're the worst. I mean, the US, the Fed has been very clear about the path for raising interest rates. And yes, the Bank of England does not look good in comparison to the Fed. But then we have the ECB, which is absolutely shockingly awful. You know, they have inflation running at 8.1%, and they've got deposit rates of minus 0.5%. You know, so compared to the EU, sterling looks like a total safe haven. Comments, Richard?
My comment really, Keith, is I think everything you've said is correct. And the whole thing is incredibly unpredictable. It's also incredibly unstable. But the timing of the actual events that cause the instability to result in big changes in asset prices is impossible to predict, completely impossible to predict. You can just have some sense of where it's going to go and be prepared for it. So inflation watch this week. So looking at this table, the reporting for May is the CPI for the EU is 8.1%, Germany is 7.9%, very similar actually, as you'd expect. And inflation is still increasing in Europe. The core CPI, 3.8%, as we discussed earlier, seems rather incredible under the circumstances, but inflation is continuing to increase in Europe. So the Taylor rule is the rule which suggests what the Fed funds rate ought to be in order that the Fed achieves its 2% inflation target. So the Taylor rule is suggesting the US rate should be 10%, the actual rate is 1%. And in the EU, it's recommending 7%, whereas the actual rate is minus 0.5%. So we have a big disparity in the theoretical interest rate to contain inflation and where we currently are, which would suggest that inflation is not beaten. So the market has started to price in ECB interest rate rises for the coming year. And the implied rate now is 1%. So that is a substantial interest rate rise from where they currently are. But where given that PPI is over 30% and CPI is 8%, an interest rate of 1%, the Taylor rule suggesting 7.5%, there's an enormous mismatch. The US labour force isn't really growing, which means that there is going to be continued pressure on wages, upward pressure on wages, because there's an insufficient source of labour within the US. And this is the PCE, the Personal Consumption Expenditures Index for the US. And as the commentary says, it dipped in May, but you know, it's a tiny little dip. And given the trajectory of all these lines, inflationary lines that we see at the moment, I think we have to wait and see whether any downturn in inflation is persistent or whether it's just a sort of statistical anomaly.
Yes, wise words.
And the PCE price index for the last 10 years, you can see that there has been this gradual trend upwards from post-pandemic, really, but we've had a very big drop in the month-on-month number, the latest month-on-month number. So EU inflation is continuing to rise, continuing to outrun expectations. The US, we may be seeing in those PCE graphs, we may be seeing that inflation is peaking. We have to watch for a little bit longer. In the UK and EU, there's no indication that inflation has peaked and monetary policy remains irresponsibly, incredibly lax.
Thank you, Richard. Right, now on to Recession Watch. Now, in the US, the National Federation of Independent Businesses does a monthly survey of its members, and this is the survey of small businesses who expect the economy to improve over the coming year, and it's at a 50-year low. Although the business optimism survey was slightly better, but again, not great. So small businesses in the US are expecting the economy to get worse. These are new job postings by S&P 500 companies, and they seem to have peaked, although still very good numbers by historic standards, but coming down. Financial conditions are tightening, and this is something we will talk further about later. But what this chart shows is that there's a correlation between financial conditions and the ISM manufacturing PMI, i.e. the real economy. And so now financial conditions are deteriorating. If this correlation were to hold, we'd expect real world economic conditions to also worsen. And I thought this was a really interesting chart. So this is from Chartered Accountants Mazars, and they have this financial cycle, which is something I hadn't seen before. And so they are saying that the central banks are tightening, and they are expecting us to enter a financial recession about now, and the economy to follow the financial recession into actual recession later in this year. And when we talk about financial conditions, this is the National Financial Conditions Index from the Chicago Fed. You'll see that financial conditions have deteriorated markedly over the last year and are now positive. And, if you look back over the last 20 years, that doesn't happen very often. Happened in the pandemic. And then before that, really only around the great financial crisis. So that is something to watch, and something that we will aim to cover regularly going forward on the podcast. And it's been a very bad week in bond markets. So bond yields have already tightened. I previously thought they were peaking, but then this week, bond yields really blew out. So if you are a company looking to refinance, you're going to have to pay more for new money. And one of the consequences of the financial tightening is that the money supply actually shrank in April in the US. It fell by 82 billion, which in percentage terms of total money supply is trivial, but it is actually the largest ever drop in the money supply in absolute terms. And QT is due to start in June. So the Fed, having built up an enormous balance sheet, will now let maturing bonds roll off. So it won't reinvest the proceeds. Its balance sheet will start to shrink. Now, next week, we will do an extended segment on QT. But here, what you need to know is that the money supply is shrinking, and that's not good. Okay, so in summary, financial conditions are tightening. Leading indicators are warning of the risk of recession, but as yet, there is no sign of recession in the US or Europe. And actually, the PMIs seem resilient.
So we're just going to have a quick run through the UK cost of living support package that was announced by the government this week, basically funded by a tax on oil companies. As I think it was last week, wasn't it? And as Keith covered last week, the tax on oil companies is complex and is very dependent upon how much they reinvest in developing resources. So there is no certainty that the government will raise the money it expects to raise from these windfall taxes from the oil sector. But notwithstanding that, they have committed to spending the putative amount that is raised in any event to help UK households cope with the high energy bills funded in part by this windfall tax. So all UK households will receive a one-off grant of £400. So no means testing at all. And then a further 8 million of the poorest households receive a means-tested £650, as they call the cost of living payment. Then 8 million UK pensioners will receive a one-off £300 winter fuel payment, and all households in the lower council tax bands, 80D, receive £150 rebate on their council tax bill. So they have tried to target some of these support measures to lower income families. So what are the projected increases that we're looking at? So in January, the Ofgem price cap was £1,277 per annum. In April, it was raised by £700 to £1,971. And there's a putative further roughly £800 rise in October 2022. So a total rise of around about £1,500 per annum in an average household energy bill. And pensioners will receive, in total through these rebates, £1,500. Lower income households will receive £1,200. So it does actually offset significantly this increase in energies. So it achieves its objective of making increasing the affordability of energy for low income households. The question is, what's going to happen in future? There is no certainly no guarantee. I don't know if there's any expectation that energy prices will drop. We have been looking at the shortage in oil, fossil fuel production over demand on this podcast for many months. And there is no indication that energy prices will drop. Is the government going to spend 15 billion a year continually? We don't know. It is a sort of an intermediary package without any long-term plan, I suspect. So it's expected that only about 5 billion of this will be funded by the windfall tax in the end, which puts another 10 billion onto public sector borrowing. You know, I think the government is heading towards being 50% of the UK economy now, which is far too large for a successful economy. And that, I think, comes back also to the point we discussed earlier, the Bank of America saying, is the UK moving towards emerging market economy? And we have a lot of structural issues that this government, for reasons sometimes in its control, sometimes out of its control, but this government is pushing the economy, in my view, further away from a market economy, more and more towards a demand economy. And it isn't doing anything to address the fundamental underlying economic problems. Will this package affect inflation? Probably not. In reality, it's too small.
But yes, you're right, Richard. But the question is perception.
Yes.
If international investors just see, the UK being anti-business, putting windfall taxes on and increasing support, one of the side effects of this package will be to subsidize domestic demand for energy and therefore keep prices up for businesses. So businesses don't receive this package. So not great for British business.
I remember a year and a half ago, Keith, having a conversation with a friend of ours who said that they were entrenched in the financial sector. And he said that his main fear was when the bond markets lost faith in the UK government.
Yes.
And when that happened, he said, all bets are off. And the problem is that each one of these little steps is moving us closer to that point in time.
Well, that is prescient, Richard. We will talk about that more in a little bit, because it was a bad week for my bond bet, amongst other things.
Yes.
Okay.
That's the timing issue, Keith.
Yes. Okay, so let's talk about the UK windfall tax. Now, one of our regular viewers, Steve Brown, the CEO of Orcadian Energy, tweeted this week about the effect of the UK windfall tax on his projects. Now, regular viewers will know that we did a share talk on Orcadian Energy last year, and they have various heavy oil projects in the North Sea. And all those heavy oil projects target discovered resources. So the resources are there. It's a question of getting the capital to develop them. And his point is that the windfall tax includes this provision to offset profits against new investment. So profits reinvested into new projects avoid the windfall tax to the extent you can retain 91.25% of your profits that are reinvested. And this is Steve Brown's modeling of the effect of the energy profits levy on one of his projects, the pilot project in the North Sea. And you can see that, so this is the NPV 10 of the project. And you see that the energy profits levy clearly reduces its profitability and its NPV for a non-producer. So a company that does not have profits that it can reinvest. But if you do have profits to reinvest, you can essentially write off a lot of the initial capital cost against profits and thereby avoid taxes you would otherwise have to pay. And that means actually you really de-risk the project. But, and this is quite crucial, this windfall tax, we don't know how long it's going to last. Now, the initial reports were for that it was going to last a year. And then in the small print, it said up to 2025 if high oil prices persist. And the thing is, getting projects into the North Sea is not something you can do in a year. You know, some of these fields that, for example, Orcadian are looking to develop, they were discovered in the 1980s and they're still not developed. In order to go from exploration to development can take decades. And so you'd have to, in order to take advantage of this provision, you'd have to have a project which is pretty much ready to go. Companies like Orcadian could really benefit because they have a project that's ready to go. But even then, you'd need to be able to get all the equipment in place quite quickly to do some drilling. So in summary, this could be really good for companies with, drill-ready investment prospects in the North Sea. But I don't think there are too many of them. And actually, Orcadian suddenly starts to become quite interesting. And we wish Steve Brown and his team well.
Okay, so we thought we'd do a little bit, now the dust is settling, a little bit of on the impact of Brexit on the UK economy. This is a non-party political discussion. And we're just simply looking at what's going on in the economy. So in 2021, the EU is a destination for 46% of our exports. So the EU is a hugely important destination for our exports, a hugely important trading partner. And as we've discussed, we have a balance of payments deficit. So we need to be maximizing our exports. They are crucial to our economic health. The balance in grey line, this chart goes from January 1997. So UK trade with the EU in pounds. You can see that there was a slow declining trend in the balance. In other words, we were moving gently into a larger trading deficit with the EU. Then we had the eruptions around Brexit and also COVID, and it's hard to differentiate those two in sort of 2020. But what you can easily see is there's a huge degree of volatility has suddenly come into the equation, and the trend doesn't look healthy.
Sorry, Richard, could I come in here actually? Because this, so what this shows is that since the Brexit vote, if you look at the bottom chart left, you'll see that the quarterly trade in goods and services as a percentage of GDP for the UK essentially has stagnated and net fallen since the Brexit vote. Whereas in every other country, trade has grown. And the bottom line is, if you throw a load of extra regulations and red tape in the trade between you and your main trading partner, it's going to have a negative impact on volumes of trade.
Yes, that's very true, Keith. And I think anecdotally, a lot of small businesses have given up trading with the EU because it's become too difficult.
Yeah.
UK trade openness has fallen more sharply than in any other advanced economy since Brexit. Our trade openness has fallen by 6.2%, and the rest of Europe's trade openness has increased, markedly so for Italy.
What this says to me, Richard, is that trade within the EU, they've replaced goods and services they would have sourced from the UK with goods and services which they've sourced from within the EU. So you see a surge in trade within the EU and a decline in trade with the UK.
And the UK's foreign-born population growth has slowed since the Brexit vote. As we said, 2016. The EU, the red line is the EU-born population of the UK, which is now declining, and the negative for the first time in since this chart began. And the non-EU population of the UK hasn't actually changed terribly much. It fluctuates a bit, but it hasn't changed terribly much over the last 10 years or so, 10 or 12 years.
Yep.
So a significant impact upon EU citizens working in this country.
Now, this is crucial. This is foreign direct investment. And we talked earlier about how the UK runs a structural current account deficit and must run a capital account surplus to balance the books. And if you look at FDI inflows into the UK, then they're growing much more slowly than they were. And that is structurally bad for sterling. I thought this was amusing and actually true.
So, in conclusion, Brexit has increased tariffs and regulations on UK companies for importing and exporting with the EU, our largest trading partner. And that has led to a reduction in trade as a percentage of GDP, which we would expect to be an ongoing drag on economic growth. And the UK is historically a major trading nation.
Okay, moving on to China. Okay, so good news, COVID cases in China have collapsed because of their draconian lockdown measures. I will long remember the robot dog running around with a loudspeaker. That was really dystopian. And general Chinese COVID cases appear to have peaked for now. This is Shanghai, where they've come down to zero, and Shanghai is reopening. So although as we speak, I think you still can't go to a restaurant, Richard.
What I don't understand, Keith, is why isn't this chart simply going to repeat from like mid-March and go up until exponentially until they lock down again? What have they changed that's going to stop that from happening?
Well, I agree. More on that in a bit. So in Beijing, it's come down sharply, but there are still cases. But on to Richard's point, vaccine update amongst the elderly appears to be slowing. And if we look at international comparisons, you'll see that the target demographics for vaccinations, i.e. the elderly, China is doing materially worse than other countries. So what is there to stop further outbreaks of Omicron?
Particularly as the vaccine doesn't appear to work very well.
Well, I believe 3 doses, it does kind of have an effect, but they do need good booster shots.
Yeah.
And this is the economic cost of the lockdown in Shanghai. Industrial productivity plunged by 60%, unsurprisingly, when you lock everyone in their homes. I'm surprised it's not 100%, actually. And if you look at China as a whole, industrial production fell during April. Retail sales fell. So the economy is not doing well. And if you break down what people have been spending their money on, well, they've been spending it on food, medicine, beverages. If you're stuck at home, you're going to drink, and oil, and they've been cutting down on everything else. So when you look at the Chinese labor market, there are indications that the Chinese economy is slowing. So this is the percentage of Chinese graduates who are unemployed. Chinese graduates can't find a job. Suggests a weak labor market. And Chinese home sales are falling. And bear in mind that the housing market is subject to positive and negative feedback loops. If house prices start falling, then consumers tend to step back and not buy a house in the expectation that house prices will fall further and they'll get a bargain. And so currently, with house price slowing, you could see those negative feedback loops come into effect. And if we look at long-term Chinese house prices, they're now falling, having had a very good run. But Chinese property is really expensive. So this is average house prices compared to the GDP per capita. You'll see India is ludicrous, but China, very high. And this is from Nordea, and it is the price to income ratio for properties in various cities in China. And they say if the ratio of price to income is above 7, then the market is in a bubble. And if you look at Beijing, it's at 26, Shanghai 19. So property prices in China are really high. And property investment is fallen to its lowest level in a decade, all of which paints a picture of a slowing Chinese property market. And this is year-to-date sales for Country Garden, one of the big property developers. This is contracted sales, year-to-date growth. Not good.
No.
And all that matters because if you look at a breakdown of Chinese GDP growth, so the latest figures were 2010 to 2019, you see that it's almost all their growth has come from investment. A little bit of total factor productivity, but essentially the big movement of people from the farms into the cities to work in factories has largely been achieved. And so the way the Chinese have kept up GDP growth is just by throwing investment at everything. And so if the property market is now slowing, and that means investment is slowing, you could see a real slowdown in the Chinese economy. And they have admitted that they may well miss their annual growth target of 5.5%. And as Richard points out, there's no reason why Shanghai and other cities can't go back into lockdown in a few months' time. If there's a further outbreak of COVID, they don't have an exit policy. Although there are indications that the lockdown policy is controversial at the highest levels of the Chinese Communist Party. But what goes on there, we have no idea of. So, being able to predict the outcome, I think, is impossible. So, anyway, in summary, the Chinese economy is vulnerable to further lockdown. So we currently have a bout of euphoria in iron and copper markets as the Chinese economy opens back up. But will that last? Or next month, will Shanghai go back into lockdown and the whole thing unwinds? Watch this space.
So we have some other charts for you this week. Corporate lending in the Eurozone area, and that is sharply higher in over the last 6 months or so. Don't know what the reason for that would be, but I'd suggest there's potentially a lot of investment going on.
Well, I don't know what corporate interest rates are in the EU, but if deposit rates are minus 0.5% and let's say corporate rates are 4%, inflation's 8%, then if you expect that to persist, then surely you borrow as much money as you possibly can.
Yeah, maybe so, Keith. Although you'd think they'd want to invest it in something, and I mean, probably being invested in arms manufacturing and oil and gas processing plants. Is this? You do this one, Keith. I'm very dubious about these things.
Right. Okay, this is the Atlanta Fed's GDP Now forecast for US GDP for Q2. So they take various real-time indicators. And what they are saying is that US GDP in Q2 will come in around 2%. And that number has been pretty stable over the course of the last month. So the Atlanta Fed is saying that US GDP is holding up. It's growing slowly. It's not deteriorating. And
US bank lending is back. It's increasing quite quickly. So that suggests there's a significant demand from corporations, companies to invest. Although, of course, we also know that they use it for share buybacks.
Jamie Dimon, the head of JP Morgan, last week talked about how credit conditions in the US were really good and hence great for banks. But then this week, he was talking about how there was an economic hurricane coming down the pipe. So how he kind of reconciles his two statements, I just don't know.
Well, there's a lot of smoke and mirrors, isn't there? And I would be very surprised if Jamie Dimon proceeded to talk entirely out of sync with the Fed. That the Fed's most active policy is talking whatever their particular plan for the moment is, talking it up. So they're all talking about how they're going to be raising interest rates. They're not really raising interest rates, 0.5%, but they're talking about how they're going to raise interest rates. And so if they're trying to slow the economy down by talking it down, Jamie Dimon is contributing to that by saying it's all going to get really shitty, everybody. And so, it becomes a self-fulfilling prophecy, doesn't it? I am deeply cynical. So US house prices have diverged from earnings, which they also did in the 2000s, coming back down in sort of 2010, 2012. But the divergence here is very big.
Yeah. We expect this gap to reduce. Yes. And we don't expect earnings to rise that much. Work it out.
Yeah. And house builder sentiment, we talked about this the other week as well, but house builder sentiment is starting to drop away. Home buyer sentiment collapsed. House builder sentiment appears to be following it down. So weekly checklist equity markets, it was a bit of a mixed week, really. So the FTSE All Share did very little. And the Stocks Europe actually did very little, really. The S&P 500 and the NASDAQ bounced. The NASDAQ particularly bounced hard, down 21% for the year. but up 5% on the week. And the topics had a decent week, both up around about 2.4%. Bitcoin had a bounce alongside basically the Nasdaq and the view of tech, and the pound fell 0.4%, and it's now down nearly 7% year to date. And the dollar index didn't change on the week, but it has fallen back about 3% from its high of a few weeks ago, where it was at 104. So it is now 6.3% up on the year. Number of buying minus selling 6 months rolling look back. Basically what this is saying is that insiders are buying more and selling less. Insiders have bought the dip, which typically is considered to be bullish.
Yeah.
I mean, the big question is, have the US markets stopped their fall, or is this just a bear market rally? And is the decline going to continue in due course? This is a chart that speaks for itself.
Yeah.
Oh, so this is how the mighty fall, isn't it?
Mm.
Bailey Gifford American B fund, which obviously did extraordinarily well, and it has come back to earth with a bump. And as Keith has put on the side here, the lesson from this chart is remember to sell.
Yeah. They have, if you are long this thing, you had loads of opportunities to sell. This is a classic topping pattern. Sell off, bounce back to near close to previous highs, and then frankly remained there for months. Get out.
The tech market took a decade to heal after the 2000 bubble burst, and didn't really begin to outperform until 2010. And what this basically is saying that the exuberance, the effervescence in the market, which isn't tied to any economic reality, takes a long time to fully heal and for businesses to start to be valued at the previous levels. So we've hardly dropped off from the top. This chart would suggest we may have a very long way to go.
Yeah, but also when we reach the bottom, that investors in tech will be thoroughly sick of tech, having lost a lot of money, and it will take years for them to regain their confidence.
And the valuation of US small caps has collapsed back down to the pretty much back down to 2008 levels, and that is it's like a 60% fall, isn't it, Keith?
Mm. So, I mean, this is really interesting. There's been a big correction in US small caps. So one way of interpreting this is that the market actually is really pessimistic about the economic prospects going forward, and they're skeptical about forward earnings. So the PE ratio could just be wrong.
Yeah. So this chart is showing that tech earnings per share expectations are continuing to rise. So no sign that analysts are expecting a recession. And well, we shall see, shan't we? But clearly, there's still a lot of bullishness out there about tech.
Yeah. Well, it puts the sell-off in perspective, doesn't it? They've delivered the growth, but share prices are absolutely cratered, and that's the danger of buying very highly rated tech companies.
Yeah.
On Richard's question of, is this just a bear market bounce? Well, you know my thoughts.
Yeah, and mine as well.
Okay, on to commodities. Well, industrial prices, are they peaking? And the same is true of industrial metals. We'll obviously go through the details in a bit, but on an aggregate level, they've had a very good run. Okay, on to energy commodities. So in general, pretty good week. Brent was flat. WTI rose 2.5%. European natural gas futures drifted off as we go into the summer, but are still up 19% year to date. Coal continues its grind higher, up another 2.4%, up 143% year to date. Uranium bounced up 4.5%, up 14% year to date. Okay, numbers relevant to the oil market. So in the US, total inventories fell by 4.8 million barrels. But just looking at private sector inventories, they rose by 620,000 barrels. So releases from the Strategic Petroleum Reserve were enough to fully satisfy demand for oil last week. Although, obviously, you can't keep on drawing down the SPR forever.
There seems to be a political strategy, doesn't there, Keith, to try and contain the oil price in the US by releasing from the SPR in the hope that at some point there will be a stick save from OPEC and the production will suddenly up. And the question is, what happens to oil price if either demand doesn't drop substantially or OPEC doesn't increase supply?
Yeah, two things, Richard. First of all, I did a special during the week on US policy in the 1970s. And basically Nixon responded to surveys which showed that US consumers preferred to have fixed prices at the pump and rationing to higher prices at the pump and windfall taxes. So what they wanted was low prices at the pump. And so this, you can see there, these releases from the Strategic Petroleum Reserve in that light. Biden is trying to keep prices at the pump down, but it's very easy to release 5 million barrels a week and run down the reserve. But at some stage, you're going to have to buy those back. Buying 5 million barrels a week, I mean, at the bottom of this recession, if oil prices go low, suddenly he's going to be trying to buy 5 million barrels a week. And that is going to, well, A, cost money, but also provide a real support for the market. Watch this space. Yeah. So moving on to US crude production, again, flat on the week, only up 100,000 barrels a day since the beginning of the year, despite record high oil prices. Actually, I'll take that back. Despite very high oil prices. The Baker Hughes rig count fell by 2. So this is crude Brent. Very interesting. Energy CEOs and executives have been selling their shares. Interesting. Now, oil had a very volatile week because earlier in the week, we had EU sanctions on Russia, sent the oil price shooting up, and then OPEC Plus discussed allowing Russia to open the taps and suspending its quotas, and then agreed to increase their production by 650,000 barrels a day in both July and August. And that sent the oil price back down again. It just shows the vulnerability of the oil price to politics currently.
It does.
Now, pause, take a look if you're interested. This is a really good map from S&P Platts Global of Russian export routes, their export pipelines. Now, the bottom line is their export route to China is capped at about 1.6 million barrels a day via pipeline. And they then have a European pipeline, which provides about 1 million barrels a day. But obviously, Europe is now going to stop taking oil from the sea route, and only a few countries in Europe will continue to take oil via the pipeline. And this is a reminder of OPEC's April production, where essentially they missed their quota by 2.7 million barrels a day. So they're now increasing the quota. If they can't meet the quota, then what difference is that going to make? Although obviously a few countries like Saudi, the UAE and Iraq in particular do have spare capacity. And now thank you to Richard Wilk of our Discord for sending me this. This is all about how Russia has changed its export patterns. And essentially what it's done is it's increased its exports by sea. So this is the amount of Russian oil on the water in tankers transporting oil around the world. And you'll see since the invasion, it's doubled. So they're exporting a lot more oil via tankers. Whereas Russian oil exports to Europe have collapsed due to sanctions, to be offset in part by exports to India. But the thing is, it takes a long time for a tanker to go from Russia to India. So although they've got more oil on the water, it's on the water. You know, the export flows take longer and are slower.
I've just done a little sum in my head, Keith, so forgive me if it's completely wrong. But if Russia ceases to export 1 million barrels of oil a day to Europe through the pipeline, effectively, we've had a 35 million barrel increase in oil, Russian oil on the water, which is 35 days of lost exports, if you like, from the pipeline. But there's a limit to the amount of capacity that the world shipping market can take onto the water, which means Russia is possibly now bumping up against the buffers of what it can actually export via tanker that it can't get out via pipeline.
Yeah. And you see its exports have actually fallen by what's that? Over 1 million barrels a day. Now, in the US, gasoline prices are shooting higher. But once we've talked about in recent weeks, and we'll talk about again next week, is that there's a structural lack of refining supply. And so it doesn't matter how much crude you have if you can't refine it and turn it into diesel. And gasoline and diesel prices are heading north because inventories are running down.
And as we know, Russia is a huge producer of diesel.
Precisely. And we've put sanctions on Russia, quite rightly. But as a result of that, the crack spread has shot through the roof. So this is how much you make by refining a barrel of oil into various different products. And the oil majors who have refining capacity will be making out like bandits. So, moving on to Dutch natural gas futures. They are drifting off as we go into the summer, but reminder, the December futures ain't moving. We're expecting the energy crisis to return later in the year. Coming up this week, I will be doing a special on the prospects for US natural gas prices. Bottom line is that over the last decade, US natural gas has had a supply shock, which is now coming to an end. And US natural gas prices having been suppressed for a decade, are they going to start rising towards European levels, which are much, much higher? Now, this is EU natural gas inventories and restocking at a record pace. And that is part of the reason for the fall in European gas prices. Coal, this just looks like a straight line to the moon. Uranium ticking back up. Richard.
Keith, weekly industrial commodities, sort of bit of a mixed bag, really. So aluminium down a chunky 5% on the week. aluminium previously a high flyer, as we know. Cobalt a little bit down on the week, but copper up 6% on the week, presumably in the hope of Chinese reopening. Chromium a little bit down on the week. Iron ore 10% up on the week, again presumably in the hope that China manufacturing is going to start picking up again. Lithium up 2.2%, neodymium 0.8%, nickel, which sort of follows, we think, iron ore, up 3.3% in the week, up 34% in the year. So, and so starting to move back up after that huge spike that we saw with the short selling fiasco. Tin up 2.5% on the week, ferrovanadium unchanged, so not following the price of iron ore, and zinc up 3.5% on the week. So the charts, aluminium had that huge spike and it's basically lost all of it. Cobalt, fairly sort of settled around $70,000 to $80,000 per ton. Copper is showing a bit of strength again after a very weak period for the last few weeks. Chromium, iron ore, lithium, neodymium, and nickel, which if you draw a line under the trend from beginning of 2022, you can see it's sort of starting to regain that, possibly to regain that upward trend. Tin and ferrovanadium and zinc. So precious metals, a relatively good week for precious metals in comparison to the time that they've had recently. So gold up 0.5%, silver up 0.6%, platinum low, big jump 7.3%, and rhodium down 2.6%, palladium down 0.2%. Don't know what the reason was for the jump in platinum. Do you, Keith?
No.
There's a chart of gold, silver, platinum, very volatile really. Rhodium.
Looks to be drifting off, rhodium.
It does. I mean, car manufacturing is down, isn't it? Presumably that affects demand for rhodium and palladium. And palladium, despite the fact Russia supplies over 40% of the world's palladium, the price has done nothing. It was a brief spike in late February, early March, and it has regained pretty much where it was before. So it suggests that palladium demand has dropped substantially.
Yeah. Okay, thank you, Richard. On to rates. So big moves in bond markets this week. So there was a general sell-off. So, and that in the UK, I think the sell-off was in part due to the Bank of America note talking about sterling potentially becoming an emerging market currency. So you saw the 2-year drop by 25 basis points on the week, and the whole curve shifted upwards. But it wasn't just confined to the UK. If we look at the periphery of the Eurozone, the Greek 10-year rose on the week by 16 basis points. Italian bonds rose by 31. Now that is a concern. So the Italian 10-year now yields 3.3%. So moving.
That's also a 10% increase in yield on the week, Keith.
Yeah. Now this is market expectations for Fed rate rises, and they're expecting a 0.5% rise in June, a further 0.5% rise in July, taking US rates to 1.8%. Now, when we talk about the Bank of England base rates are at 1%. How will the Bank of England respond? By the end of the year, the market is expecting US rates of 2.6%. So massively higher when they are now. But investors have been buying bonds, and they have got stuffed this week, frankly. So this is the Italian 10-year. That's not a happy chart. Yields are rising at some stage, and this is before the asset purchase plan of the ECB ceases. It ceases in July. So the Eurozone crisis could well recur. Italian debt sustainability gets worse as this rate rises. Richard.
That's a really big worry, isn't it, Keith? If we go back to the time where Mario Draghi said, we will do whatever it takes, but Christine Lagarde saying we will do whatever it takes doesn't have any credibility. Not because she's Christine Lagarde, but because there's nothing left in the European Central Bank tank.
Yeah. Now, the difference is, but when Mario Draghi said it, inflation was really low.
Yeah.
Now inflation's really high. This is Greek. Again, not a happy looking chart.
You know, these interest rates should be at or around the rate of inflation. They should be in an unmanipulated market. These interest rates should be at 8, 10, 12%. And the cost of keeping them low is extraordinary.
UK, 2.2%. UK 10-year. You know, what's a fair value for the UK 10-year?
So if you look at these interest rates, Keith, assuming they're market-based, and you know, say they're not manipulated by central banks, then these are saying that inflation is going to fall very rapidly to, you know, in the UK, 1.5% or 2% or whatever. And that's just not going to happen. And if the market participants know that's not going to happen, then what are they saying?
Well, actually, Richard, I think it could fall very quickly. It all depends on how bad the coming recession is, essentially. But the data in the US this week and Eurozone, which showed essentially economic resilience, you know, that scared the bond markets. You know,
hence the sudden big upticks in their prices.
Yeah. And this is my trade. So we talk about the gilt market. You know, I bought the 50-year gilt at 91, and it's had a really bad week. I'm down about 9%. And so a regular viewer of ours and my old friend Hasib asked me during the week, what was the reason for UK 30-year yielding 2.4%, much lower than the US? And actually, I don't have a good reason for that. You know, so could the UK 30-year go to 3% and match US? Absolutely, it could. Now, if it was to reach 3%, then the 50-year would have a further 22% to fall, i.e. a lot. So, you know, there is absolutely no reason why UK gilts shouldn't just keep on falling. And so, having put the trade on in very small size, thankfully, I ain't adding to it. This is the US 10-year, bad week. Okay, finally, concluding comments. Financial conditions are tightening. That's what those bond yields are. And question, does that mean, because we've talked about how central banks are in a fix. They can't raise interest rates because if they do, they send the economy into recession. But if they don't, then eventually the bond market loses confidence in central banks' commitment to the 2% inflation target, and they start to sell off. Have we reached that point? Richard, your thoughts?
Well, I would say, Keith, we've been discussing this issue actually since we began Portfolio Matters in January 2021. And I would say that this is evolving as we have sort of predicted that it would, not necessarily in exactly the same way and not necessarily with the same timings, but the dilemmas of the central banks that we have talked about are coming to be the reality, and of course the significant inflation problem. So then our basic thesis is that central banks are trapped. This big inflationary spike has trapped them again. And the downside for the central banks is that they're quasi-independence. When you start to get people rioting on the streets because they can't afford food, this independence of the central banks will disappear in a flash. Politicians take it over. So in some sense, everyone's fighting for their lives. Central banks are fighting for their lives. Politicians are fighting for their lives. And the poor old investor and citizen is left stuck in the middle. And to me, this comes back to, how is it going to resolve? And to my mind, it does not resolve well. There is no good outcome. And therefore, how do you protect yourself from a bad but unpredictable, in terms of timing and what the actual badness would be, outcome?
Yeah. No, yeah, absolutely right. Expect volatility, be nimble.
Yeah.
At some stage, bonds will be a great buy, as will equities, but they could be a lot lower than this. And actually, if sterling goes into tailspin, consider buying gold. And the great thing about gold is that it's incredibly liquid.
And I would just say, when I started my career in the first company I worked for, we had debt at 15% with the Canadian Imperial Bank of Commerce. And that was not odd. That was normal. Imagine what happens to your portfolio if interest rates go to 15%. You don't have to move there yet. You have to know how you will move there. Yeah.
Very good point. I can't see that happening. The economy would disappear in a puff of smoke.
Yeah, exactly, Keith. I completely agree with you, but I just think it's so difficult to predict what will happen because there are so many complex moving parts. So it is an outlier, but
And finally, China appears to be reopening for now. Watch this space. So, Richard, what have you been up to this week?
Thank you, Keith. So my portfolio had a very small change on the week, plus 0.2%, which puts me at 9.3% for the year and a relative performance of 10.3%. Purchases none, sales none, still sitting on my hands. My precious metal mining shares had a very volatile week. They sort of lost something like 6% on Tuesday, I think, and then they gained about 6% yesterday. And for those of you who do or are thinking of investing in precious metal mining shares, they are very, very volatile, and you just have to sit it out. Otherwise you get bounced out, you get whipsawed in and out all the time. You have to adopt the I don't care mindset, which is not necessarily very easy. But I've got a couple of things I wanted to talk about. So this is, you remember our economists' inflation projection chart, where basically the inflation projections drop off at 45 degrees to the line of the curve. So this is Fed balance sheet reduction projections. And you have the same effect of the projected line disappearing at 45 degrees to the actual, and lo and behold, it doesn't come about. We are now projecting QE4 is going to end. We're going to have QT, and lo and behold, look what's going to happen to central bank balance sheet debt. Is it heck? I say it's not going to happen. And that is why I am still sticking with gold and silver mining shares, gold, silver. I am convinced that the outcome of this horrible economic mess that we're in is going to be good for precious metals. So it's taken a long time and it hasn't happened yet, and I may be wrong, but that's my rationale.
I agree with you, Richard. So actually, before you move on, I agree with you on gold. And this is a great chart. Thank you for sharing this. And I completely agree that there's no way on earth that they're going to manage to shrink the balance sheet as much as expected. But the trouble with gold is it's a safe haven. And if there is a big sell-off in equity markets, then people need to liquidate their gold holdings to pay for margin calls. So yes, medium to long term, gold's great. But in a sell-off, gold gets hit with everything else. Correlations go to 1.
Yeah, I agree with you, Keith. So you have to be very careful about how you manage that. And you sort of need to drip feed into gold, in my view, and you need to be agnostic to the price in some senses. You have to either believe my thesis or not. And if you don't believe it, then don't invest in gold and precious metals, because you will get bounced out. This is oil priced in various currencies, including gold. So oil priced in gold is the bottom yellow line, and then oil priced in fiat currencies. What does this tell you? Well, it tells you that since the world went off the gold standard, fiat currencies have been printed ad nauseam by governments, and the value of the fiat currency in your pocket is continually depreciating. And look at the British pound. That is not good.
Yeah, no, that's a great chart. I love the oil priced in gold. It's essentially flat over the entire period. So, gold is the proper currency.
Yeah. So what's the problem with the price of oil at the moment? Well, it depends what you measure it in. I thought I should just stick with the Bitcoin because we talked about it last week, and it's had a bouncy week that hasn't really gone anywhere. And you can see my price target line is still sitting there at around about 12,000. And then this is the ARK Innovation ETF. And as we were going through the earlier the charts, we had the chart of the NASDAQ, and it's just tipped slightly off the top, hasn't it? And you look at ARK, and now in fact, if the NASDAQ has a further 30 or 40% to fall, where does that take ARK down to? Well, it takes it down to 2,000, which I suspect is below where it has ever been. I don't know that, but I suspect it is. And that would suggest that ARK started buying, if that happens, ARK would have started buying tech shares when they were already overvalued.
I agree with that. I mean, you can look at the ARK portfolio as essentially containing a load of unfunded liabilities, because it's got all these technology companies that are not profitable. At some stage, then he's going to need to raise more money.
The other thing that struck me, Keith, is that great chart of how long it took to overcome the 2000 tech bubble. Made me think, gosh, there's no rush to get into this stuff, is there?
No.
You can wait 3 or 4 years and watch it every month, not every week. And then I thought uranium shares have been very, very volatile. And so I chucked in a chart of Cameco, which I own. And it's interesting, it is following that thick black line that I put in there. So that's something perhaps just to use as a benchmark of what's going on in uranium. And then yellow cake is similar, although yellow cake is further above that line. I don't know exactly how well yellow cake tracks the uranium pounds per metal price, but you would think it should be pretty close. But I think it can trade at a discount or a premium depending on investor enthusiasm. So I'm still waiting for uranium. And the other thing I wanted to say about uranium is I read an article the other day that says that these small modular nuclear reactors have a huge waste problem in comparison to the waste per megawatt generated is something like 30 times as much as it is in a large reactor. So yes, they address an issue, but they create a big waste issue, which clearly is a downside for them. So that's just something to watch. So Keith, what was your week like?
Thank you, Richard. I had a bit of a crappy week, frankly, down 0.25%.
But a very good year.
Yeah, very good year. But North Sea oil producers continued to sell off after the UK windfall tax. And frankly, my tiny bet on gilts well, unwound badly. So and I've still hold it, but it was had a terrible week. So anyway, great year. I continued to sell down the portfolio, just selling everything. No buys. And this is my allocation at the start of the week. So I was to 70% cash, 2% bonds. I've been selling down the smaller stuff. I've hardly touched my Shell, which is my biggest holding. These are my equity holdings. I continue to hold my gold plat, which has actually been doing all right. Selling down the oil. And just to recap, this is the 2071 gilt. And Richard is much better at the crayons than I am. So I thought that it seemed to be forming a nice base here, and I bought it when it ticked up. No, I'm gonna have to go on a technical analysis course or something. But my first forays have not been very successful. So there you go.
It's very difficult to get those things right, though, Keith, to be fair to you.
One thing I want to talk about. So, obviously I'm not looking very clever with my sale of my oil assets into gilts. But, I play the cycle. So I'm now selling out of equities in the belief that, markets are going to top because we're going to go into recession, and timing the move into bonds. And timing these moves, hopefully I only have to do them once every few years. I never get it right. So you have to be prepared to take quite a lot of pain short term in the hope of getting rewards as the cycle changes. And so these are my trades in Shell during the pandemic. And Shell peaked in July of 2019 above £26. And then I held on, and at £13.30, I thought it was an absolute bargain. And I bought in decent size on the 9th of March. And within the day, it fell from £13.30, where I started buying, to £12.50. I then continued buying all the way down to £9.30. And that, so within 2 weeks, I was down 30% of my initial investment, then bounced back, and I'm looking all right. And then reminder, later in 2020, as it became clear that lockdowns weren't going to end, the market drifted off again, and I resumed buying. £11.30, £10.30, £10, £9 was the bottom. And at that stage, I'm really not looking very smart. Down 30% 7 months later after my initial investment. But I'm now selling it at £24. I've sold a couple of tranches when Shell has gone above £24, and that is doubling my money. So that is the prize. But you never get the timing quite right. You have to be willing to accept pain.
I think, Keith, this is a fantastic example of understanding your thesis and knowing why it is that you're making this investment. And if you had not understood the oil market and you'd simply said, well, it seems quite low, I'm going to buy it, you would almost certainly have got shaken out of this trade way before you started to see the gain of it. So, it is important that to invest well, you do have to have an understanding of the market that the business operates in, and you have to have a good understanding of it, because otherwise your decisions aren't necessarily rational. And I think this is a very good example of you understanding the oil market very well and being confident that you're right, but knowing that it's going to take an amount of time that is imponderable.
Yeah, no, absolutely. Thank you, Richard. The thing is, I really, when you look at my performance, it mainly comes from actually timing the market, and so trying to understand these cycles. And as I finish selling down the portfolio and I have more time on my hands, I will be doing a piece on my investment approach. But getting the top and the bottom of the cycle is really tough. You just need to accept that you're not going to get it right and suffer some pain. Now, the lesson I learned from this, and I'm actually implementing, is when I bought on the 9th of March, I bought in size because I thought, God, it's such a bargain. And of course, it just kept on falling. So when I've now bought my gilts trade, I bought it in very small size. It's blown up, but it hasn't cost me very much. And now I'm just going to sit and wait.
The benefit of buying in small sizes, if it does well, you don't think, damn, I've missed out. Okay, you might want to buy some more. If it does badly, but it is going to do well at some point, you just have an eye on it.
Yeah.
As long as it's small.
Yes.
It's, if you like, it's the cost of doing business.
Yeah. And I would say that when I did this trade, and I said in the weekly that, I needed to buy some because it would force me to pay attention and to care. Well, that has been really successful. I do care. When it's down 10% in a week, you think, I've got that one wrong. Okay, just moving on to a couple of stocks. So this is Tullow Oil, which is an oil producer, big debts, invested at the wrong stage of the cycle, assets in Africa, particularly offshore Ghana. And this week it merged with Capricorn Energy. Now, Capricorn Energy, oil company with limited assets in Egypt, some other development assets, but cash rich. So the combination will combine heavily indebted Tullow Oil with cash rich Capricorn Energy, and not going to cover them this cycle, but I think that is an interesting combination. The market, as you can see from these two charts, hardly reacted at all. Especially for the Jubilee edition, Stuart Owen is joining us from Tokyo to update us on his portfolio.
Yes, and the news is not quite as good as for Keith and for Richard, because year to date I'm up 1.5%. So rather behind both Keith and Richard, who've made much chunkier bets on oil and commodities. My portfolio is rather more balanced and traditional, but I was reasonably happy with plus 1.5%, particularly when I read John Authers this morning, who was reporting that almost no major asset classes was positive year to date. So I'm definitely well behind the commodity boys here, but just about ahead of zero. So looking at where my performance has come from, well, as ever, there's a trickle of income. My portfolio yields just under 5%, so that ticks in pretty regularly. And I show here the asset allocation in my SIP. You can see that there's about 35% in REITs, and then there's green energy, infrastructure funds, asset finance, making smaller portions, and then about 10% in some fixed income and 20% in equities. Now that pretty big chunk, 35% in REITs, just to say that is not reflective of the asset allocation of my overall portfolio. This is very skewed into my SIP because of tax. I wouldn't hold so many REITs outside of the SIP, but because income tax is higher than capital gains tax, I always try to put higher income things like REITs into my SIP. The other thing to say is that property income distributions from REITs are treated very tax advantageously in ISAs and SIPs. So it's really worth putting what holdings you have of REITs into a SIP or an ISA. In effect, you get about a 25% uplift to the dividend you would receive in a normal broking account. The other thing to say about this big REIT position is that this is not things like sort of offices and land securities type exposure. This is some of the stuff that I've covered in some of the specials that Keith has published. So this is things like warehouse REITs, student accommodation, residential accommodation REITs, and social housing REITs. And a lot of these have the inflation-linked rental contracts that I've covered in a couple of the specials. So that's why it's a rather large exposure. The other interesting thing about my portfolio I thought might surprise people is that 20% equity allocation includes some frontier markets. Now, normally when I come on this program, I'm sort of Mr. Prudent and talking about sort of earning 5 to 7% and being happy with that. And that's definitely true at the moment, but ultimately underlying my investment approach is a value approach. And if I look around world markets, frontier markets, the only place where you can buy things on 10 to 12 times earnings, 4 or 5% dividend yields. So I've got a quite chunky position in a frontier market investment trust, which has actually done reasonably well even this year in the shakeout, because the manager holds quite a few commodity stocks from frontier markets. In terms of activity year to date, I've been gradually buying a little bit of gold every month. Often there's some income in my portfolio. I recycle that into gold. I've also been very persuaded by the argument about oil. So I have bought a US energy ETF because my bet was that the US majors like Exxon and Chevron would be very hard-headed and would be likely less influenced by ESG issues and by a windfall tax. Though it was interesting to hear Keith's presentation during the week about what the Americans can do in a time of crisis, when Keith was presenting on energy stocks in the 1970s. My other recent addition to the portfolio has been to top up a position in Home Income REIT. This is a REIT which provides accommodation to homeless people and is in effect receiving a housing benefit on an index-linked basis. So that's where I am to date, definitely behind Richard and Keith, just about sort of doggy paddling above zero.
Thank you, Stuart. Well, the all shares down 1% on the year, so you're actually outperforming the all share by 2.5% with much lower risk. Can I just ask what the dark blue wedge here is? Is that cash?
That's cash. Yes, that's rather disappeared against the background there.
Of course. Yeah, got it. Okay. And how are your bonds doing? Because this week we have had a big sell-off in the bond market.
Well, these bonds, I'm classing them as bonds, but it's primarily preference shares from a range of insurance companies and the old Abbey National, renamed Santander. I bought these years ago, yielding 8%, and they still yield 6% after price rise. But the thing is, they have such a wide bid-offer spread that I really don't want to trade them. Yeah. So I've just bought and hold them, and I accept the fact that in a period like them at the moment that they're going to be hit a bit. But I'm still earning 8% on my book cost, even if it's only 6% now on the market price.
Great. Okay. Thanks, Stuart. Thanks for dialing in. Enjoy your holiday. And we look forward to having you back in July.
Splendid. Thanks.
Thank you all for watching. Good luck navigating these volatile markets. In the meantime, please can you press like and subscribe to the channel. And it's goodbye from Richard Wheater.
And it's goodbye from Keith Jordan. Goodbye.
Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website. including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.